In this video, I'm going to show you a way of trading without the use of any technical indicators. And the particular strategy which I'm going to show you identifies reversal points in euro dollar and can achieve a win rate or have an accuracy of almost 90%. So if you've almost given up trying to use indicators to get some sort of consistency in your trading, then this video could be of interest to you. I'm going to show you a backtest report for the strategy, which runs back to January 2010. So at the time of filming, that's almost 14 and a half years of data. So it's been working for quite some time now. And since discovering the strategy a few years ago, I've also been using a variation of it in my own trading. The strategy uses a few simple rules for the entries and the exits. Now, the idea of me showing you this video or showing you this strategy is just to demonstrate that you don't have to overcomplicate things in order to find an edge or a long-term edge in any particular market. I've prepared a quick slideshow, which we're going to look at in a minute, which explains exactly how to get in and out of the trades. Then we'll have a look at the performance report. Now, I've split the backtest and the performance report into two sections. The bulk of it is going to go from January 2010 through to January 2022, so we've got that first 12 years. And then I've left the last 2.5 years as the most recent data, because I think that's where you're going to be most interested in the recent performance. So from 2022 through to the present day, which is in June 2024, that's the second set of data which we're going to look at. So let's go and have a look at that slideshow and show you exactly how things work. The strategy works on the daily chart of euro dollar. Let's look at the long trade entries first. So the number one rule, we must be flat. We must have no open trades. So if we're already short, we're going to wait for our trade exit from our short position before we can actually go long. Okay, so we need to be flat. We'll look at that on the charts. Number two, wait for a red candle. So when we see a red candle and the close of that red bar is less than yesterday's low, that's our next setup. And then number three, once we see that setup, we enter a buy stop order at the high of that red candle. And it's only valid for 1 day. That means if for the next session, if the high is broken, then we get into the trade. If the high of that red candle isn't broken within that session, then we cancel the order and we look for a new trade altogether. Looking at the shorts, it's pretty much the opposite as you might expect. Number one, again, we must be flat, no open trades. And we're waiting for a green candle now. And the close has to be higher than yesterday's high. When we see that, we want a sell short stop order at the low of that green candle. And again, it's only valid for that next candle, that next bar, or that next session. Okay. If we're not in a trade within that next session, we cancel the order. Trade exits, basically we're exiting at the end of the session if we're in profit. This is our good old bailout exit. I like to use 16:45 to 16:55 Eastern Standard Time, so between 5 and 15 minutes before the end of the session. Check whether we're in profit, and this may be within the same day that we've entered the trade. If we're in profit, then we're going to exit. If we're not in profit, we leave the trade running. And the other exit is a stop loss of 250 pips. So we're only going to get out of a trade one of two ways. We're going to exit into profit, or we're going to hit our stop loss. Very, very simple. Looking at some long trade examples here. Looking at the first example. So this first bar here, we can see that we've got a red bar and the close is less than yesterday's low. So what we would have done, we would have put a stop order to buy at the high of this bar here. And you can see the next bar, that high wasn't broken, so we didn't get into a trade. But this was another setup, so we would have put the stop order at the high of this bar, but we can see again the high wasn't broken, so we cancelled the order. But we got another setup, and finally, the day after we saw this, we did get an entry here. I don't know if you can see that, whereabouts my arrow is, that's where the trade entered as we broke the high of this red bar, and then the close of this bar was slightly less, so we weren't in profit, but the next day we saw that the close was up here into profit and we exited the trade. Similar sort of scenario here. It wasn't until we got here that the high of the previous red bar was actually broken and we got in the trade here, and then again after that next session we took some profit. Similar scenario here, and again 1 day later we took some profit. Again, here we've got another long example, and here we've got some short examples. So green bar here, the close was higher than yesterday's high, so we would have put a sell short order at the low of this bar, and obviously that wasn't broken. But we got another setup, so we put a sell short stop order at the low of this green bar, which was broken the day after. And then 1 day later, around about the close, we were in profit, so we exited the trade for some profit. And another trade here. This one took us 1, 2, 3, 4, 5 days until we actually saw some profit, and then we exited the trade. In the report, I've actually included some trading costs. I've actually included $40 worth of costs, and we're trading 100,000 units or one full lot. So $40 of cost, that's equivalent to 4 pips worth of costs. So let's have a look at the backtest data for that first and largest chunk of data from 2010 through to 2022. Here in multi-charts, you can see that we've got 2 separate charts, and they're just different date ranges. So the first date range is the 2010 through to 2022. And if I just enlarge that, we can see some of the trades which are being taken on the chart. There's the last 5 trades. So let's look at the performance report. Net profit, we can see that it's making 24,600 over that 12-year period. That's what the equity curve looks like. It's had some really good periods, some fairly flattish periods, and then some slightly better periods. But overall, definitely moving in the right direction. It's taken 212 trades with a win rate of 88%, average trade of $116 as after costs, and that's equivalent to 11.6 pips. You see our largest losing trade there, 2,500 or just over 2,500. Our stop loss is actually $2,500. That's our 250 pip stop loss plus the 40, which is our 4 pips of trading costs. So that's our largest losing trade. So it's nice to see that there is some consistency, and we are definitely moving in the right direction over that first 12-year period. For such a simple trading strategy, the performance over that 12-year period is okay, isn't it? The good news is, though, for the next set of data, which is the most recent data, the performance has got even better. I'll show you that in just a moment, but firstly, I wanted to offer you a PDF guidebook which I've created. In the guidebook, I call it the 22-page Beat the Markets Strategy Guidebook. In there I outline in detail 3 more trading strategies which are rule-based, a little bit like the one which we're looking at today. If you're interested in that, I'll leave the links down below, because at the moment you can get that absolutely free. And for those of you who are looking for even more strategies, I've included another 6 strategies in my popular trading course. And interestingly, in the course I actually include a strategy which is a little bit similar to one we're looking at today. However, this time I've included like a clever trade filter which improves the performance even more. So if you're interested in that, I'll also leave the links down below. Of course, it's not just strategies in the course, there's also a ton more information. It's all about how to make consistent profits using rule-based trading. Now let's go and have a look at the up-to-date or the most recent performance for this strategy. We've already seen the earlier performance report for this early data, but let's look at this one, which is got data from 2022 through to the 21st of June 2024. It's not quite the 21st actually, it's the 14th of June 2024. Net profit $10,700. There's the equity curve, and that's been performing quite nicely, hasn't it, over the last 2.5 years. See the close to close, we can see that the green dots show us that we are making new highs right up until this day, or the most recent bit of data. Taking 49 trades, percent profitable is up in this period to 93, almost 94%. Average trade is a lot larger actually as well, it's 21 pips, and largest losing trade is still the same, which is our stop loss. In fact, what I'll do now is I'll just include the whole data set so we can see it as one big picture. So I'm going to go from January 2010 through to June 2024. And looking at the overall performance, obviously we've got the trades combined. We've got our 89% profitable, $135 for the average trade, But let's look at the equity curve, and we can see that, sure enough, we're in a good period here, a bit like the early period. Then it went flat, and then, like I said, this most recent period has been performing particularly well. Looking at the annual period analysis, we can see that over those 14 years, we've only got 2 losing years. And we can see 2010 was a very strong year, but then, as we can see on the chart, 2022 was a good year, 23 was pretty good, and so far, 2024, it has been performing quite well. In fact, this year alone, we've only got 7 trades, but every one of those has been profitable. A common observation, or sometimes even complaint, I get from normally newer traders to a strategy like we're looking at, is that it only trades about 20 times a year. And I totally get that. I totally get that most traders want to be placing trades more than once every 2 or 3 weeks. So what's the answer? Because you can't force more signals from any one single strategy. And the truth is, you're going to be very hard pushed to find one strategy with a win rate of nearly 90%, which trades 2 or 3 times a day and is profitable after trading costs. Those sort of strategies might exist, but I haven't found them yet. Not a strictly rule-based one anyway. So what's the answer? Instead, do what I do. Trade more than one strategy. I trade a whole collection or portfolio of strategies. Let's say you trade 5 strategies, which trade 20 times a year. Suddenly, that's 100 trades a year. Trade 10 strategies, that's 200 trades a year. This is how we build up our trading without focusing just on the one strategy. Have a look at some of my older videos for some more strategy ideas, especially if you like these strategies with higher win rates. You should be able to build up a collection or a portfolio of strategies too. So anyway, I hope that helps. I know it's a short and sweet video today, and I know I haven't been uploading recently. I have been really busy, mainly working on my own strategy development. And unfortunately, I find making the videos in between working on these developments, I just find the videos a little bit distracting. So it's been really nice just to focus solely on strategy development. So I hope you understand. But thanks for staying until the end of the video, and I hope to see you on the next one. But until then, this is Jared Goodwin, and thank you.